Do lenders count a car lease as debt the same way they count a car loan? And the answer may surprise you that no, mortgage lenders treat a car lease and a car loan differently when calculating your debt to income ratio, or DTI. And the difference can catch first time homebuyers completely off guard. Welcome, I'm Julie Marion at the First Time Homebuyer Workshop, where we educate first time homebuyers on how to navigate the crazy process of home buying. There is so much homebuyer remorse, well over 50% annually, and we want you to know you don't have to navigate a very important investment alone. So let's unpack this car question and the DTI question that plagues first-time homebuyers. While it is true both a loan or a lease impact your monthly liability, underwriting rules deviate significantly when it comes to how the remaining balance is handled. Let's talk about the car loan first. If you are financing a car with a standard auto loan, lenders look at the monthly payment and how many months you have left on the contract. There is something called the omitting rule, and it's exactly what it sounds like. The underwriters omit a debt. So here's how it works. There's something called the 10-month exception. If you apply for a conventional loan, and I mean a mortgage conventional loan, if you aren't sure what that is, then you need to take the First Time Homebuyer Workshop for sure. But let's just focus on what we're talking about. So if you have 10 or fewer monthly payments remaining on your car loan, the underwriter will usually omit that debt from your DTI calculation entirely. The logic is the bank views this as a short-term liability that will naturally drop off your plate very soon, freeing up your cash flow. Now, the car lease. The car lease is the opposite. It is a never omitted rule. Car leases are just the exact opposite. Even if you only have 2 months left on your lease, the lender must include that payment in your debt ratio. It cannot be omitted. And here's the logic. The logic is that a lease implies that when the term ends, you either have to buy another car, resulting in a new loan payment, or purchase and replace a vehicle. Underwriters assume that you will always need a car, meaning that the monthly expense isn't actually disappearing, it's just changing forms. So here's another catch, the cosigner catch. If you co-sign on a car loan for a lease or for a family member, that payment will automatically count against your DTI as well. The only way the lender will remove a co-signed auto payment from your profile is if you can prove for 12 consecutive months of bank statements that the other person has been making the exact payment on time directly from their bank account. Now, if you have just graduated from college or you're thinking of the process, well, first I'll get the job, buy a car, and then I'll look for a condo or a house. Well, you might want to think about the debt first. That's where this light bulb takeaway is for your budget. And the reason why is, as I said at the beginning, auto debts can heavily restrict your purchasing power. A $500 monthly car payment can strip out roughly $75,000 to $100,000 away from your maximum home loan eligibility. If you have 4 years left on a 5-year loan, a mortgage underwriter will count the full monthly payment against your debt to income ratio. Because 4 years equals 48 payments, it sits far above the 10-month exception rule. Underwriters review this as a long-term, ongoing financial obligation that will directly impact your ability to make your monthly mortgage payment for the foreseeable future. So the 10-month thing is your golden ticket to your DTI. Now, you may be thinking, well, how does this really affect my home price affordability? Lenders don't look at the total balance of the loan, what you owe overall. They only care about how that specific monthly obligation shrinks your monthly income. They only care about the payment. So, for example, if your car payment is $450 a month and the underwriter subtracts $450 directly from your qualifying monthly income, in terms of your purchasing power, that single $450 auto payment can reduce the maximum mortgage amount you qualify for by roughly 70 to 85,000 depending on current interest rates. So let's talk about solutions and options. What are your options if your DTI is too high or too tight, too high or too tight? If having 48 months left on a loan that is pushing your debt to ratios too high to qualify for the house you want, you have a few strategic levers that you can pull before applying for the mortgage. Number one, pay the car loan down to 10 months. If you have the liquid cash available, you can pay the principal balance down until there are exactly 10 or fewer months payments remaining. Once you reach that threshold, the lender can omit the debt from your DTI entirely. Now, note that you cannot simply prepay 10 months of payments in advance. The actual remaining balance of the contract must be reduced to 10 months or less. The other thing you can do is refinance the auto loan. If your credit score is improved or if interest rates have dropped since you bought the car, refinancing to a lower monthly payment, even if it extends the term, will lower your DTI and immediately boost your mortgage qualification limit. The other thing you can do is you can pay off the car completely. If you have enough extra savings that aren't earmarked for your down payment or closing costs, paying the vehicle off entirely eliminates that liability, hence lowering your DTI. Always run the scenarios by your loan officer first because keeping cash reserves is sometimes more important to an underwriter than erasing a small debt. Math, math, math. It's all math. These strategies are free here on YouTube, and inside our workshop, we give you 40 years of professional real estate and urban planning solutions. If you think this is helpful, head on over to the First Time Homebuyer Workshop where you will save even more money. But let's get back to what you can do if your DTI is too high. So, what if you have college debt, say $250,000, and the car situation? Now what? And now we get to discuss the options for you and college debt repayment in another video here, but let's keep going. So this is a classic scenario where the cash flow logic conflicts with the mortgage underwriting logic, right? On paper, getting the lower monthly payment on a new car sounds like a smart financial move. However, when it comes to your debt to income ratio, adding a new auto liability on top of the $250,000 in student loans creates a very specific set of hurdles. Here's how a mortgage underwriter will calculate your debt to income ratio with this debt profile. So you have the new car loan and the payment is everything. Even though you bought a car and you chose a payment option of a lower monthly payment, the underwriters don't care about the overall balance of the car loan, whether it's the vehicle new or used. They only look at that exact monthly payment listed on your credit report. And the DTI impact is that if the new car payment is $450, that $400 is subtracted directly from your monthly qualifying power. The length trap is because it's a brand new loan, you have nearly the full term remaining, 60 to 72 months. And this means that you can't utilize that 10-month exception to omit the debt. It is locked into your DTI for the foreseeable future. So you really want to weigh this factor. You've got to look at your numbers. Everyone is different. Now, with $250,000 in student loans, how this hits your DTI depends entirely on the types of mortgage loan you're applying for and your current school debt repayment plan. And if you have $250,000 in student debt, the income-driven repayment plan, known as the IDR, is the wild card. Now, if you're applying for a conventional mortgage loan, And if you are on an income driven repayment plan, you will have an official IDR statement. That report shows your monthly payment. Let's just say it's zero due to low income relative to the debt. Or let's say it's heavily reduced to say about $150 a month. Conventional underwriters will use that actual number, and that's a massive win for your DTI. Now, if you apply for an FHA mortgage loan, the FHA rules are much stricter. Even if your credit report or your IDR statement says that your payment is zero, the FHA underwriters are legally required to calculate 0.5% of the total balance as your monthly debt. So for 250, that means the FHA underwriters will automatically hit your DTI with a hypothetical $1,250 monthly payment, regardless of what you actually pay per month. And that really stinks. And it's kind of a lot in addition to your car loan. So let's look at a hypothetical situation and assume $100,000 in annual income. It's 8,333 gross monthly income. The max debt allowed is 45% for your DTI, which gets you to 3,750 per month total. You subtract the car payment of 400, and if you're on the IDR plan as the example, let's just say it's 200. The remaining balance left for your entire mortgage payment is $3,150, including your principal, your payment, your principal, your interest, taxes, and insurance. Now, with this monthly budget of $3,150 for your principal, interest, taxes, and insurance, you're looking at a maximum home purchase of approximately $410,000 to $430,000. Now, these are general numbers based on nationwide averages. Of course, you will calculate this for your area you are in, but I'm just trying to give you an idea that there is light at the end of the tunnel. So now let's look at the same income with an FHA loan. So the income's 100,000, the max debt allowed is 45%. 3750 is the monthly total. It's all the same, right? Your car payment's 400, that's the same. But the student loans under the FHA rule is 0.50%. And remember that this is higher. So you've got 1250 there. The remaining amount of the money the bank says that you can spend for a mortgage is reduced to $2,100 a month. And this significantly slashes the price of the home you can afford. If your monthly payment, interest, taxes, and insurance budget drops to $2,100, your target price shifts down from 400-ish to approximately 260 to 280 for the house. So see how this drops to about half the home price? So, really, we are talking about the car and how this folds into your situation. And even though we're mentioning college debt too, I don't want to veer too far off from the car because we have a video about the college debt. So, the reality is that the car may be typical to have in your area, and you might just like having one. I personally never lived without a car, but I did make some choices about the type and the costs of the car. Considering these factors, there's sort of a phase two for the car purchase strategy. You can minimize the damage, so to speak, because in my mind, a car may be a non negotiable for your income, but it's how you acquire it that dictates your future mortgage approval. So, buy, do not lease. As we discussed, the car lease payment can never be admitted by an underwriter, even if it has 2 months left. And a car loan gives you a lot of flexibility. Prioritize your monthly payment over the total price. Usually, financial advisors don't tell you to take out a long-term car loan like 72 or 84 months because of the interest. However, for the mortgage underwriter, the overall debt balance doesn't matter. It's only the monthly payment. Taking a longer term loan forces that car payment to go as low as humanly possible, and keeping it at 300 a month versus 500 saves a massive amount of your home buying purchase power. Keep your credit clean. Buy the car before you start your mortgage pre-approvals. And then do not touch your credit card balances or apply for any other financing. Also, check into as many financing options as you can. You can go to the dealer, you can go to the bank, and so that when you get ready to go home shopping, you'll be in good shape. So that's phase 2. Let's move on to phase 3. Packaging the information for the underwriter. You get to talk with them in a written form. And when the file has a fresh auto loan, the underwriter looks for compensating factors to approve the loan. This is how you build a bulletproof file for them. Number 1, document the car's purpose, the job connection. Have your employer, not you, write a clean professional letter on company letterhead stating that a reliable personal vehicle is a requirement for your position. Or copy the official job description showing that travel is required. Underwriters like to see that a new debt directly supports the stability of your income. Homework. Yes, you have homework. If you have college debt, go and watch this video. I hope this was helpful, and be sure to check out our free class, Home Buying Chaos Unwrapped, that explains who does what, when, why, where, and how during the real estate transaction. I'm Julie Marion, founder of the First Time Home Buyer Workshop, and I can't wait to meet you. Bye for now.